While watching bullish price actions, let us inform you our review on MLGO. MicroAlgo Incorporated is a company that's been attracting attention lately, and for good reason. It's a holding company focused on developing cutting-edge central processing algorithms, which are core to optimizing computing power across a variety of industries. For those of you who might not be all that familiar with the technical side of things, think of central processing algorithms as the intellectual backbone behind speeding up and enhancing computing performance, whether it's in the cloud on your devices or behind the scenes at data centers. MicroAlgo's technology helps businesses across sectors like internet advertising, gaming, and intelligent chip manufacturing to optimize their operations and enhance their ability to handle massive amounts of data. What's interesting about MicroAlgo is that they are in a prime position to ride the wave of growth in some of the most exciting and high-demand industries today. The internet advertising industry is booming, with advertisers looking for ways to integrate more sophisticated algorithms into their campaigns to reach the right audience more effectively. Gaming, meanwhile, has become a multi-billion-dollar industry, where speed, performance, and data optimization are paramount. And, of course, the push toward intelligent chips, used in everything from electronics to autonomous vehicles, means that data processing capabilities are more important than ever. So, MicroAlgo's core technology is in a sweet spot, and that gives the company a lot of room for growth, assuming they can execute on their potential. However, despite all the promise in these high-growth sectors, the company has run into some hurdles lately that are causing investors to pay closer attention. The most notable of these challenges is related to the company's debt, specifically a $20 million convertible bond agreement that MicroAlgo entered into in October 2024. Essentially, these bonds gave creditors the option to convert their debt into shares of MicroAlgo's common stock. The kicker here is that, to settle this debt, the company is planning to issue new shares at just 80 cents each. When you compare that to the current market price, which is well above $5 a share, the situation is pretty clear. This is a significant discount. Now, this news has caused quite a stir, and understandably so. The stock price of MicroAlgo has skyrocketed by an impressive 260%, hitting $9.11 per share shortly after the announcement. On the surface, this looks like fantastic news for anyone who's holding shares in the company, and it's easy to see why investors are getting excited. But, as always with investments, there's a bit more complexity behind the scenes than just a big jump in price. Issuing new shares at a steep discount isn't a move that companies take lightly. While this allows MicroAlgo to settle its $20 million debt without having to take on more high-interest loans or default on its obligations, it also means that more shares will be floating around in the market. And when more shares are issued, that usually leads to dilution of existing shares, meaning each existing shareholder's stake in the company becomes worth a little less. So, while the stock price is climbing right now, it's important to understand that once those new shares hit the market, it could cause the price to pull back as the market adjusts to the increased supply. To make matters more complex, the 80 cents per share price is tied to a specific agreement with creditors, meaning that MicroAlgo has no choice but to issue the shares at that price to settle the debt. From the company's perspective, it's a smart move to avoid default and to keep the business running smoothly. But from the perspective of current investors, it's a bit of a double-edged sword. Yes, the company is stabilizing its financial situation, but at the cost of diluting the value of their shares. This is where the real risk lies. The stock price may be higher in the short term, but over the longer term, the dilution could drive the price back down. So if you're an investor in MicroAlgo, what does this mean for you? For starters, you've likely seen a significant jump in your investment value with the stock price rising 260%. But the question is, can this rally last, or is it just a temporary surge fueled by the excitement around the debt settlement? And if you're thinking of getting into the stock now, you have to ask yourself whether the current price represents good value, given the risks of dilution. What investors should be looking at here is whether the company can continue to execute on its business model and capitalize on the growing demand for its services. After all, While the debt issue is certainly a hurdle, it's not the only factor in the company's long-term prospects. MicroAlgo's products, central processing algorithms, and intelligent chips are crucial to industries that rely on efficient data processing. And with sectors like AI, gaming, and advertising continuing to grow, the demand for these kinds of technologies is only expected to increase. But there's still a lot of uncertainty in the mix. The company's ability to execute on its growth strategy will be key to determining whether the stock price can continue to rise over time. The industry is competitive, and MicroAlgo is not the only player in the game. If they can continue innovating and building strong partnerships with companies in the gaming, advertising, and chip manufacturing sectors, then there's definitely room for the company to grow. But if they face challenges, whether that's from competitors, technology failures, or difficulty managing their debt, the stock price could easily experience more volatility. It's also worth noting that there's a bigger picture here that investors need to consider. The fact that MicroAlgo is issuing new shares to settle its debt may seem like a necessary evil in the short term, but it doesn't address the company's ongoing financial stability in the long term. Will they continue to rely on debt or equity raises to finance their growth? How will they handle future debt obligations without facing similar challenges? These are questions that investors should keep in mind when assessing the long-term viability of the company. Another aspect to watch is the company's ability to scale. MicroAlgo is operating in industries that are ripe for growth, and their services are well positioned to benefit from the trends in AI, gaming, and advertising. But to scale successfully, the company needs more than just a great product. It needs to be able to expand its market share and manage the costs of growth. Whether that involves expanding its sales force, investing in R&D, or forming new strategic partnerships, the company's ability to scale effectively will be critical in determining whether it can sustain its current trajectory. For those considering investing in MicroAlgo, there are a few key factors to monitor. First, pay attention to how the market reacts to the dilution once the new shares are issued. It's likely that the stock will face some pressure once the initial excitement wears off. Investors should also keep a close eye on the company's future debt obligations and whether they can manage them without facing more dilution or financial strain. Lastly, it's crucial to stay updated on the company's performance in the core industries it serves, gaming, advertising, and chip manufacturing, and whether it can continue to capitalize on the growing demand for its technology. In summary, MicroAlgo is a company with a lot of potential, but it's also navigating some tough financial waters. The recent jump in stock price, while exciting, comes with a lot of risk due to the dilution effect of issuing new shares to settle debt. For long-term investors, the next few months will be crucial in determining whether the company can maintain its growth trajectory and whether the stock price will stabilize at its current levels or face a decline. If you're considering buying into MicroAlgo, the key will be managing expectations and understanding the risks involved. While the company has a bright future in some of the fastest growing sectors today, it still has a long way to go to prove that it can handle the financial pressures and continue growing without getting bogged down by its debt. Stay informed and tread carefully. This could be a solid investment if the company executes well, but it's far from a sure thing. Please subscribe, give the video a like, and watch more from our playlist. Thanks.